Hi, Mark Oswald, your host for Londonderry Heart, Home, and Soul. With me tonight is Kim Carpentier with Valley Credit Builders.
There you go.
I got it.
Get it.
All right.
Good job.
So I asked Kim here this evening to talk really about credit repair, and that's kind of your wheelhouse.
Yeah, kind of right there, yeah.
And there's mystery and myth in a lot of
Mystery and
that.
myths and a lot of credit. You hear a lot of stories out there on the street, so hopefully we can set some of those myths aside for some people tonight.
So let's just start with maybe credit bureaus and credit reporting.
Sure. There's 3 credit bureaus: Experian, Equifax, and TransUnion. Now they're not government. They're not owned by the government. They're not part of the government. They're 3 separate entities. They are supervised by the government, though, and they're pretty well regulated. But they are separate. They're traded on the stock exchange, so they're public companies. Mm-hmm. Being separate, that's why you have 3 different credit scores. So if anybody ever applies for something, they usually get 3 different credit scores, and they can be all over the map. Because the people who report to the credit bureaus are not forced to report to all 3 of them. All right, so you could have somebody reporting on one bureau that isn't reporting on the others. That's why the score differential. Plus, the 3 different credit bureaus have different algorithms that'll calculate the score. So they'll come up usually pretty close, but you could have a 50-point swing between the high and the low, in the mid. So that's how the credit bureaus get all their information from data providers, they call them. So it'd be like banks and credit card companies and auto loan places and all that stuff, all right? Anybody and mortgage companies and stuff like that, they'll report to the credit bureaus. And that's how they calculate the score. Now, there is the FICO score. Now, FICO is the predominant scoring mechanism out there. It's probably used in 90% of all of the credit decisions out in the marketplace today. Mm-hmm. FICO's independent from the credit bureaus, has nothing to do with them, is not owned by them. It's Fair Isaac Company is what it used to be called. Now they just go by FICO. So that's the predominant one. They'll take the information from the credit bureaus and they'll scrape that information. And they'll calculate a credit score. So that's how when they go to the bank and they get 3 credit scores, that's usually a FICO credit score.
Right.
Now the banks, the credit card companies, I should say, didn't like the fact that FICO was not part of them and couldn't control them, so they started doing their own credit scoring mechanism, right? Mm-hmm. Well, a lot of confusion entered into the marketplace at that point in time because the credit bureau started out with a scoring mechanism. FICO, the high score is 850. Well, the credit bureaus came out one with the high score of 1,000. So someone could get a credit score of 800 from the credit bureaus, right?
850, I thought I was doing pretty good.
Yeah, doing pretty good, right? And then they go apply for a loan and it's 680.
Right.
And they're trying to figure out what happened. So a lot of those scores that you get online for free, I call them FACO scores because they don't have anything to do with with 90% of what the financing decisions are going to be made out there are going to be on FICO. So always try to get your FICO score. Now, you can use those other scores as guidance, I guess. Like if those scores go up, chances are your FICO score is going to go up too. But as far as an absolute number, FICO's the only one.
Is there a correlation or a association between salary and income and credit?
No, not at all. It's called a credit report. And there's a lot of people that'll call me up and say, I could have paid that, I could have paid this, I got more money in the bank. Unfortunately, it's not called an asset report. It's called a credit report. Right. So how do you handle your credit? How do you handle your credit cards? Are they always maxed out? Do you miss payments? That's going to end up affecting your credit score tremendously.
And so, and I've dealt with this as a realtor.
Sure.
That people do have a low credit score, maybe below 600. Mm-hmm. And a lot of lenders now are looking for, there's some that might be as low as 610, 620, but
right.
A lot of them want to see mid-sixes and higher. Mm-hmm. I can refer them, or the lender, in many cases, the loan officer may refer them to you.
Correct.
So share with the audience, what's your role? How do you work this?
With the credit bureaus, legally, you can report it. You can dispute anything that's incorrect, all right? timely, 7 years old, all right, so if your last late payment was 7 years ago, it should fall off your credit report, or unverifiable. A lot of times, especially back in 08, 9, and 10, a lot of these mortgage companies were going out of business. Paper was getting lost. People couldn't verify it. So you could challenge those kind of items and just say, I don't know what it is. They'd try to verify it. They couldn't verify it. It would fall off the credit report. There's a lot of other things we do, too, because the credit bureaus, they handle billions of bytes of information every minute. You know what I mean? I mean, they got people coming in from all over the place with information. There's a lot of mistakes that are made. So I work with a lot of clients on mistakes that are made also. And that's the predominant. I mean, there'll be mistakes of, the wrong late date, or this wasn't right, or it was actually 2 years ago, it wasn't this year. So we try to verify all that stuff, make sure the credit bureaus have it straight, and we try to straighten them out. Because there's a lot, you know what it is. I mean, you go from, just like you said, 580 to 620, you get a proof of the house. 620 to 680, you get a better rate.
Right.
You don't pay as much, right? And then after you get up over 700, I think that's when the insurance kicks out, right?
So what are some common faux pas, for lack of a better term, that you see with borrowers?
Credit cards. There's a big fallacy out there that you should keep a balance on your credit cards. It must have been started by the credit card companies, because you do not have to keep a balance on your credit card, right? As a matter of fact, your best score is 0 on your credit cards, right? Now you should keep them active. If you have a credit card that's at a $1,000 limit, if you're over 20%, all right, you're going to start negatively affecting your credit score, which means if I have a $1,000 limit, I got $200 on it. Anything over that, you're going to start negatively affecting your credit score. So I tell my clients, when you're trying to present yourself for a mortgage or something, it's usually 30 days prior to you try to bring that balance down to 0 and leave it there, right? The other thing is credit card companies only report a statement close date. So if your statement closes on the 11th and you get your bill on the 14th, you can pay it off by the 15 days that you have to pay it, right? But you're using it during that month, so the next time they report, they're going to report your current usage. So you're never going to be at a 0 balance when they report to the credit bureaus.
Right.
So that's why you almost have to put them in a block of ice for a month, just to make sure that you don't use them, and try to keep them at 0. That's how you can get your best score. And a lot of times mortgage brokers will send reports to me with customer approval, and I'll take a look at it, and that's the majority of the thing. You can pick up 20, 30, 40, 50 points just by paying off your credit cards. Now there could be a catch-22 on that too, because I get a lot of people that say, I'm going for an equity line to pay off my credit cards, but my credit card balance is high, that my score is low, so they get caught in a catch-22 with that.
What frequency of credit reports, how does that hurt your credit? In other words, somebody's out in the market to buy a car, and they go to 3 different dealers, and they all run a credit report.
Yeah. Well, any car pull, automobile pull, all right, over a 45-day period is counted as one pull. All right, so it's only one credit pull, one inquiry. Now that first inquiry that you have will start affecting your credit score negatively, because it's an inquiry, 30 days after it happened. So you could theoretically go into 3 different dealerships for 45 days straight, and they could all pull your credit report, and you still only get charged for one. Even though they all show up in your credit report, FICO will only use one. We'll put them all together and use one. Same rule applies to mortgages and to education debt, because they know you're shopping, right? So if you're shopping, they don't want to penalize you because you're getting all these mortgage pulls. Now, when you start applying for credit cards, that's a whole different thing, because those things can really hurt you. The inquiries for credit cards can really hurt you, especially if you have high balances. So that's the other thing that people don't realize, is that a credit report is holistic. So if you have high credit balances on your credit cards, right, and you're applying for other credit cards, that inquiry is going to cost you more than if you had lower balances on your credit cards.
Okay.
You see what I'm saying? Because they're putting the two and two together and saying, well, they're stretched out, now they're trying to get another card that they can max out also, right? Even though you may not be late, with those cards,
Right.
all right, they still see it. So that's why it's when a person will call up and say, how much is an inquiry worth? I really can't tell them because you have to look at the entire report.
whole
And even
picture,
at that,
right?
yeah, even at that report, I didn't develop the algorithm. So I really don't know how but it only makes sense that if you have maxed out cards that you went for an inquiry for a credit card, that it would hurt you more. The other thing too is the checkout time. We're in the holiday season. Checkout time. Watch out. Don't apply for those cards at checkout for an extra $20 off.
All right.
You know, because it could end up costing you a lot of money in the future.
What if there's one or two things, Kim, that you observe in your business that hurts people most? What would they be? Is there some overarching?
Misunderstanding.
Yeah.
I think that's probably the number one. I mean, people will come in and I'll start explaining some of the things that they need to do, and they'll say, well, you know, so and so told me. And that's why it's good. I enjoy talking to people. I enjoy getting out in venues like this just to make sure.
I saw it on the internet. It must be true.
Exactly, exactly. Isn't that the best, huh? Yeah, they told it on the internet.
Somebody posted on Facebook, right?
Yeah,
It's like,
yeah. And I did it, and all of a sudden my score went down 50 points. How come?
Yeah.
Well, some correlation there between what you did and what your score did, right?
Right.
Yeah, so that's that, and also credit cards. I mean, credit cards are probably the number one item in your credit report. You know, you can have all the good credit in the world, and you can have it, but if those credit cards, if you're not managing those credit cards correctly, that can kill you. That can kill your score.
Yeah.
So that would be the caveat that I would say is credit cards.
Okay. Final
There you go.
thoughts?
Final thoughts, holiday season.
Be careful out there.
Be careful out there. Right?
Yeah.
You gotta just take it easy. The credit cards, make sure you have a pay down plan. Oh, good time? Yeah.
Sure.
Holiday season. Stay away from using debit cards if you can online, because if they get a hold of your debit card information, they can drain your bank account pretty quick. Mm-hmm. And then all of a sudden, you know, even though you could get the money back in the future, it could end up upsetting like your mortgage payments, all your automatic payments that are coming out of your checking account.
Sure.
You really got to watch that. So if I always tell my clients, and I put in all kind of newsletters, just make sure that you use your credit cards, because credit cards are more stable as far as being able to get the money back, and they don't hurt you as much as a debit card would. You know, because you don't want to give anybody access to your checking account,
Good
to
advice.
your cash.
Thanks for stopping by.
No problem. Thanks for having me.
You're welcome. Thank you for watching. Enjoy the holidays. Watch out for debit cards.
Watch out for debit cards. Stay away.
And be of good heart.